Hey traders, how's it going? It's Scott Schneider from the ShadowTrader Live Trading Suite over in the Futures Room. And I am bringing you a shadow short on volatility feedback loops, dealer pivot stacks, and just all around shenanigans. And I want to use 3 days because they were pretty good examples in my opinion. And those days were July 31st, August 1st, and August 4th. So 3 sessions. So this is an ES daily 24-hour chart. So it's not just regular trading hours. This is the session of 7/31. This is August 1st. This is August 4th. You could see we had quite a substantial move off the July 31st highs all the way down to the lows. So we're talking high 6400s on July 31st down to the low 6200s on August 2nd. That's bananas. And then on August 4th, we fully retrace the move. What's that about? So on July 31st, ES opened. If we take a look at the profile, we'll get a little more nuance. And this green dot is the open. So you can see that ES opened around the 64.47 area, and we had very little activity above this open. So the high was 64.51. So right off the bat, inventory for the whole day was pretty much below the open on the last day of the month. And we ended up having what we refer to in profile auction theory as a late day spike. And what that means is we had a late day sell-off at the end period and end period, which is the last 45 minutes of the day, which is 3:30 p.m. to 4:15 Eastern time. And so that you can see pretty clearly down here. You got the base at 63.65 and a quarter. You got the low of the day at 63.51. 63.58 and a quarter. And I guess it is important to recognize that there are other aspects at play. So, dealer positioning was a factor, and it was still positive that day. So you had a positive gamma of over 175,000, put call ratio 0.64. So it was like a stabilizing flows. So the late day sell-off, the late day spike, it was from macro headlines. It was from geopolitical news. It wasn't dealer driven. And that set the stage for what happens next. So now we head into the overnight. And the weakness just continued. You could see this red line is going to show. We ended up having a gap. So from the low of July 31st, which was a spike, so the best possible outcome you could have if you want to see continuation of the spike is to never come back inside the spike and just stay below it. And that's exactly what happened the overnight. This red line is going to show you the scope of the overnight gap down to the August 1st. So we opened August 1st at this green dot, 63.11, and we had a gap and go situation. So the high of the session was set immediately within the first 2 ticks of the day. And then in that first hour, we just pushed lower. And we ended up hitting our low of the day in J period, which to me is a little significant because that is not the end of the day. It's between the 2 p.m. to 2:30 period. And it was at 62.39, and that put the SPX at about 62.12, which was the lowest level for the SPX of the entire month. And you had a lot of dealer pivot stacks there because you're near that 6,200 big round psychological level that you're going to have multiple calls and puts amongst many different expiries. So that's a dealer pivot stack. And that's, very basic, nothing, just a little bit of an understanding of the nuance of that and how it can create a hedge, and dealers will protect those levels. You could think of it as like a balance area high-low of a multi-week balance. And VIX had spiked from 17 to 22. But if you replay the session, you did have that first hour of heavy selling. But then look at how thick this value area is. The blue shaded area, 70% of the day's activity. You had a point of control at the 64.75, 64.5 area that was 12 TPOs wide. And just, not too far from the day's halfback, that white horizontal line, which is the midpoint of the session. So that's balance. That's not liquidation. So you had two-sided trade on very heavy volume. So you might have had some participation from CTAs. It wasn't just dealers, because you could see the volume over these days, and it was with the higher volatility, so you're going to get more participation. But you could see the volume. We had on August 1st, we had 1.7 million contracts of futures and 2.5 million options. That's according to CME data. And then on the 4th, the following day, it was elevated, but not as much as the first. And that is important. So that does bring us to the 4th, part 3 of our tale. And on this day, unlike the previous 2 days where you had very little activity above the open, which is the green dot here at around the 63.03 and a quarter area. And what can happen? So you have to be aware of dealer positioning. You have to be aware of price. You have to be aware of volume. You have to be aware of time. You also, as an intraday trader, directionally, potentially unhedged, you also have to be aware of inventory, short-term, long-term. And what did we observe on both the 31st and the 1st? We observed very little activity above the opens on both days. And then we had a heavy volume day on the 1st, but there was two-sided trade. There was not strong selling. There was buying and selling. So that volume is less significant as if we were getting range extension. And we trended higher all day, especially from the open. And once we got above the high of the 1st, that increased the tempo, and we started to experience two-sided trade around the 63.50 level, which was a pretty key area, another cluster of gamma, another pivot area. And that's why it took a while to get above it. But once we did get above it, we got above it with a spike. And that spike ended up filling the gap from the 31st at the 63.58 and a quarter level and closed above it inside of the range of the 31st. And in terms of gamma positioning that day, you can see the high-low, open, close, and the gamma positioning was still negative, but think about it. You had charm as a factor also. You had Vanna as a factor. You had such an increase in implied volatility the day prior, and then we didn't get anything. We didn't get continuation. We had two-sided trades. So when those puts expired, worthless, like those 0 DTE puts for that were going to be on the 4th, and then it caused dealers to be able to hedge with it too, and they bought, and that created this late day spike. And then since then, we have not been back in that area. So that was, just created a new trend. And it's why volatility isn't just background noise. It's a driver of flows. Pivot zones anchor the auction. Gamma regimes set the tone. And together they shape what looks like chaos into a readable sequence. Same market, different flows. When you see volatility spike, don't just watch the news. Ask, are dealers long or short gamma here? What are the pivots? Who are the participants at play? Are they CTAs? Are they just short-term traders? Are they retail? Are they 0 DTE crowd? Are they buybacks? Passive? Volatility arbitrage funds? Know the crowd. And you'll be able to recognize these things when they're happening and how to react. Hope this was helpful. Peace. Hey, this is Scott Schneider from the Futures Room over at ShadowTrader's Live Trading Suite. If you enjoyed this video, please hit the like and subscribe buttons. And if you'd like to trade live with me in real time, please click the link in the description below. Have a great day and happy trading.